Hi everybody, and welcome back to video number 4 in chapter 11. And when we were cut off at the 15-minute mark, we were exploring putting into practice this particular example. And just to review, they purchased a license for $20,000 here. They purchased a patent for $40,000 here. They had developed a internet connection process for $45,000 with an indefinite life. In July 1, 2026, they successfully defended a patent that they purchased in January 2026 for $11,400, and finally they incurred R&D costs as of September 1, 2026 for $75,000. They want you to prepare the journal entries for all the entries related to the patent during 2026. And then under Bravo here, at December 31, 2026, an impairment test is performed on the license that was purchased in 2025. It's estimated that the net cash flows to be received from that license will be $13,000, and its fair value is $7,000. So they want you to compute the amount of the impairment and prepare the impairment journal entry, if any, to be recorded on December 31, 2026. And Charlie, what is the amount to be reported for intangible assets on the balance sheet at December 31, 2025 and at December 31, 2026? Let's take a look. All right, so for the patents, we're going to debit patent, credit cash on January 2nd. That one's pretty easy. Here's the patent that we purchased. All right. And now at July 1, 2026, we're going to debit patents, credit cash for $11,400, and that $11,400 was here for the successful defense of that patent. Okay, now amortization expense is going to be $92.67 at the end of 2026. And we get that by taking the $40,000 patent for the whole year. We're going to take 1/5, basically. This is 60 months is 5 years. So we'll take 40,000 divided by 5, we get 8,000. For the patent defense, that was done halfway through the year. So it only had 54 remaining months. So we take 6 as a percentage of 54 here. We get $1,267 for a total of $9,267. We'll debit amortization expense and credit patents. So for Bravo, where we're looking for the impairment test, we're looking at the 13,000 and the 7,000. So here, our cost for, let's go back, the license that we purchased, which was, where are you, license? Here it is, $20,000. So the license we purchased was $20,000. And so we're going to take 8, this one was 8 months, I believe, 8 years, I should say, for that license. Yes, 8 years. So 8 times 12, 96. And so we take 1896 for our accumulated depreciation through the end of December 2026. And that gives me $3,750. Book value falls to $16,200. $250. Now, the book value is greater than the net cash flows. Therefore, the license is impaired. Book value is greater than the net cash flows. So here's our $16,250 book value less the fair value of $7,000, and that gives me $9,250 loss on impairment. So I'm going to debit the loss on impairment and credit the license for $9,250. Now for Charlie, let's go back to Charlie. What is the amount to be reported in tangible assets on the balance sheet? 2025 and 26. So here our licenses were $18,750, comprised of the $20,000 cost less the accumulated amortization, and that gives me a total of $18,750. The intangible assets as of the end of 2026, I have licenses of $7,000, and the patents are going to be $40,000 plus the $11,400 less our amortization of $92.67, which we had here. Okay. And so that gives us our presentation for 2025 and 2026. Okay, let's explain the accounting issues for recording goodwill. Goodwill represents the future economic benefits arising from the other assets acquired in a business combination that are not individually identified and separately recognized. That's a very academic description of when a company purchases a business where the purchase price exceeds the fair value of the identifiable net assets less liabilities. So that creates a number that we call goodwill. And we're going to record that on the balance sheet, and away we go. Now, internally created goodwill should not be capitalized. I think everyone would instinctively know that, but goodwill is going to only be recorded when the entire business is purchased. The entire business is purchased. Okay, let's take a look at Tractorling Company. Diversified Incorporated decides that it needs a parts division to supplement its existing tractor distributorship. The president of Diversified is interested in buying Tractorling Company, a small concern in Chicago. The illustration presents the balance sheet of Tractorling Company. So here it is, balance sheet. And we've got our assets and our liabilities and stockholders' equity, totaling $255,000. Now, Diversified investigates Tractorling's underlying assets to determine their fair values, and the fair values are $350,000. You can see, let's look at cash. Cash is already at, and then accounts receivable of $35,000. That hasn't changed. Inventory of $142,000 has changed by quite a little bit. Property, plant, and equipment has changed as well. And then patents and liabilities. Fair value of net assets, $350,000 versus, $255,000 less liabilities of $55,000 would say $200,000. So it's gone up $150,000. Okay. So Tractorling decides to accept Diversified's offer of $400,000. What is the value of goodwill? So here is our cash and our liabilities. So the fair value of the net identified assets was $350,000. We know that from this schedule here. And the purchase price, $400,000. So we paid $50,000 more than the fair value of the net identifiable assets. We're going to call that goodwill. And this is how we would show that on the balance sheet. These are now going to be shown at fair values, and goodwill will be an asset of $50,000. Okay. Okay. If the fair value of the reporting unit, including goodwill, is less than the carrying value of the reporting unit, including goodwill, there is an impairment loss. So, if the fair value of the reporting unit, including goodwill, is greater than the fair value of the reporting unit, including goodwill, there is no impairment. All right. So, here's an example. Telling Time Corporation has 3 divisions. It purchased the alarm clock division 4 years ago for $2 million. Unfortunately, the alarm clock division experienced operating losses over the last 3 quarters. Management for Telling Time is now reviewing the division for purposes of recognizing an impairment. The following lists the alarm clock division's net assets, including the associated goodwill of $900,000 from the purchase. Okay, so we have our cash, receivables, inventory, property, plant, and equipment, goodwill at $900,000, and accounts and notes payable. So our net assets, $2,400,000. Now, Telling Time determines that the fair value is $2.8 million, $400,000 greater than the net assets. So should Telling Time recognize an impairment on the clock division? Explain and prepare any entries required if there is an impairment. Well, in this case, the fair value exceeds the carrying value of the net assets, so they don't need to recognize any impairment. But what if the fair value were less than the carrying amount of the reporting unit? In that situation, Telling Time is going to measure the impairment. To illustrate, we assume that the fair value of alarm clock division is $1.9 million instead of $2.8 million. So Telling Time computes the impairment loss as follows. The fair value of the alarm clock division, $1.9 million. Net assets, including goodwill, $2.4 million. So there's a loss on impairment of $500,000. Telling Time makes the following entry to record the impairment. They'll have the loss on impairment here, $500,000, and a credit to goodwill to reduce it down from $900,000 to $400,000 here. Okay, that looks like a good place for us to stop this video. And when we return, we'll take a look at a bargain purchase involving a purchase. All right, until that time, bye for now.